In this video, we are going to talk about two Aussie dividend ETF listed in ASX. The first one is SYI, provided by State Street, also known as SPDR, and also known as Aussie Dividends, in which you can access in CommSec Pocket. I'm not endorsing CommSec Pocket, I'm just letting you know. Let's have a look at the 5-year unit price comparison for SPDR SYI and BlackRock IHD, the Aussie dividend version from BlackRock's iShare. It looks like over the past 5 years, SPDR SYI and BlackRock's IHD perform quite similarly in terms of unit price compared to IOZ, which is ASX 200 ETF from BlackRock. Based on the unit price has done better than these two dividend ETF, possibly because the return is reflected more in the dividends. BlackRock's iShares version of Aussie dividend ETF is based on an index provided by S&P, Standard & Poor's, called S&P ASX Dividend Opportunities. It has a management fee of 0.3% per year, whereas SPDR SYI has a management fee about 0.35% per year. I think they're quite similar. And the index provider for SPDR SYI is Morgan Stanley, MSCI. And make sure you watch till the end because we're going to go deeper in the holdings of both ETFs and compare the similarities because there are names that both of the ETFs are investing in. For example, BHP. Let's compare the performance according to their website. If you go to blackrock.com, iShares IHD has done a 10-year annualized return about 5.5% and 5-year annualized return about 4.3%, whereas SPDR SY or Aussie Dividends has done annualized return for 5 years about 6.3% and since inception return about 7%. Let me remind you, this video is not for financial advice. I'm not trying to tell you that one ETF is better than the other. Just want to share with you accurate information and hopefully it's educational. So this is what I did. I go through their website and I click on download all holdings of the ETF. In this case, is SPDR SYI that follows an index from Morgan Stanley. And I do the same with BlackRock's IHD. And here it is, the summarized version with its business metrics of each company shares, company holdings. Notice that I don't include the portfolio weightings because that itself becoming a financial advice because I'm just trying to show you this video that this company has done this and this financial performance such as profits, total assets based off financial year 2021 results. So let's have a look. For BlackRock's IHD that follows an Aussie dividend index from S&P, they have about 50 companies within the ETF with a total market capitalization about $888 billion. And those 50 companies has a total asset about $610 billion and the net asset is about $289 billion. In financial year 2021, they have a revenue for about $444 billion. And out of that revenue, they get a net profit after tax about $79 billion. That is roughly 20% profit margin, which is pretty amazing for Australian companies. And out of the 79 billion, this is the part that the investor of this dividend ETF are receiving. That is the dividends paid to ordinary shareholders. And for 2021, that is about $54 billion. And just to give more perspective in taxation, these 50 companies paid about $38 billion of income tax. Now let's have a look at the SPDR SYI. SPDR SYI has less companies, about 31 companies within the ETF, and obviously the market capitalization will be less, about $706 billion, and they are bringing about $341 billion. And the net profit after tax is about $74 billion, which again is pretty close to 20% profit margin as well. And out of that $74 billion, they paid about $49 billion to the shareholders. And the amount that your ETF that you're investing in will receive will depend on how many shares that ETF holds. But then, so there is more homework for you to do. Now, the reason why I keep saying that this is not financial advice, because business earnings are dynamic. Maybe in 2021, the economics conditions, the macroeconomics are very different, which impacted commodity price and the interest rate and so on and so on. It is very difficult to estimate the future cash flow for all of these companies. But just for people who are interested with why they call this a dividend ETF, it's because the market capitalization and earnings ratio, market cap to earning ratio, or you can say that the share price divided by earning per share for this company has pretty low multiple according to the average standard. For example, BlackRock IHD, based on 2021 results, they have a PE ratio of about 11. And Spider SY has a P ratio about 9. And we can calculate further the payout ratio from the dividends paid divided by the net profit after tax. We get about similar payout ratio between 66 and 68%. Maybe that's why this index are picking these companies, because they are showing consistency in paying dividends. This ratio is not 100% accurate because I don't take into account the portfolio weightings for each company shares. And since it is just informational video, we can go through the companies within each ETF, especially the similarities. What are the names that are included in both ETF? And on this table, I list down all the names that is included in both ETF, which means these two index providers agree that we need these company shares to make sure that we are getting the dividends that we are promising investor. The names such as BHP, FMG, Rio Tinto, Horizon, Sandfire Resources, Medibank, NIB, GUD, Nix Cali, IPH, West Farmers, JB Hi-Fi, Harvey Norman, Super Retail, and also Medcash. And on the next table, we have the Spider SY, the companies that is only included in Spider SY, such as Mineral Resources, that also happens to mine the lithium ore, spodumene, and Aurora, and Magellan Financial Group, the asset management company that is going through some dramas. And Spider SY also invests in oil and gas company, Woodside Energy. Now they are much bigger after the merger with BHP Petroleum. And they have Ingham's Group, Tesla Group, so they have some consumer staples as well that supplies chicken and salmon. So as long as people are eating, it seems like business are going good. And lastly, these are the companies that's only included in BlackRock's IHD because they have more companies, so there are 50 of them within the ETF. And it's pretty clear just looking at this that both of the ETF does not have any big four banks, but they are really focused in the iron ore miners such as FMG, Rio Tinto, and BHP. But for BlackRock's IHD, they have consumer staples names such as Woolies, Coles, Elders, and also gold mining companies such as Northern Star and Evolution Mining. They have also media companies such as Nine Entertainment, Seven Group, Car Sales. Oh, and they also invest in coal companies such as New Hope. So I'll let you decide which of these two ETF that suited you better with your investment strategy. I don't have the qualification to do that, but it seems like, are you happy? For example, are you happy to invest in IHD knowing that they invest in coal, they invest in media company? How is that going to impact your own portfolio? And the same with Spider SY. Am I going to be happy to have exposure in lithium spodumene mining? Or again, thank you Quintuple X for asking the great question.